Good evening, everyone, and welcome to this webinar, which is conducted by Century Financial. My name is Yogesh, and once again, thank you so much for coming. We have a lot of people joining while I speak, but since everyone is on time, we'll start this session. Before I begin, just want to make sure that my voice is clear. The presentation which I've put here is clear and easy to see. Please give me a yes or a okay if you can hear me properly, if you can see me properly, if you can see my presentation as well, because there can be a lot of network connection issues. Just give me a yes or okay if you can hear me properly. Okay, great. So 1, 2, 3, 4. So I'm hoping that everybody can hear me right now. Once again, guys, I just see one or two uh, yeses right now, and there are a lot of people here. So I just want to make sure that everybody can hear. If you can hear me, please send me a okay or a yes. So just to ensure that the audio is clear for everyone. Okay, great. So what we'll do is normally there could be a small lag in the network, but don't worry about it. This session will be recorded. It will be put on YouTube as well once the entire editing is done. And if you're not able to, give enough time to the session, or if you have to leave in between, don't worry about it. You can later on go to YouTube and check the footage of this video again. So in case if you have, you know, missed something out, you can just look at the presentation and follow up. After every webinar, I invite everyone to have a one-on-one training session with me. And these sessions are absolutely free of cost. And we just try to spread more and more awareness and understanding about financial markets and how to manage their risk. Because a lot of things have happened, especially this year. We are talking about from the very first month of the Amazon bushfires, the Australian forest fires, to almost we were on the verge of a nuclear war with countries quarreling among themselves. We are talking about North Korea. We're talking about US. We have seen trade wars between US and China. Not to mention followed by earthquakes, followed by pandemic, which is the biggest setback what we have seen in last few months. So 2020 has been a very I should not say an eventful year, but it has been a year where so many things happened, and with that, it brought a lot of volatility and fluctuations in the financial markets. Financial markets, which does not only consist of forex or currencies, it consists of stocks, it consists of commodities, it consists of bonds, it consists of indices, funds, everything. And we have seen a lot of movement happening in all those asset classes. One thing which a lot of you must have noticed, and it's something which is very common. I'm just going to put a poll on this and see what's your answer. Did you invest in any stocks during the lockdown? It doesn't matter what country, could be US, could be Europe, could be Africa, could be China, India, any country, any stock. I have a poll right now. I just want to understand if we have anyone who invested, what is the percentage of people who are here have invested in the lockdown during March to July, I should say, the good 2-3 months which we saw. anyone who invested in stocks during the lockdown. So the polling has begun. Please go ahead, keep voting. So I just want to make sure, just want to see what's the percentage of people who invested in stocks during, because those who did know why I'm saying this, and those who did not, I'll show you something really interesting, what happened during the lockdown and the post-lockdown. So today we'll learn a lot of things. We have our live platform switched on. So if anybody has questions about, how the buying and selling works, I can answer that. That is not part of the presentation, but definitely if we have some time left, we are going to see some charts and understand that, how last 7 to 8 months has been. Right. So the very essence of this session is we are going to talk about how US elections turned out. I have done this session a lot of times at different places with a different audience. So if somebody has already attended this session, the only change in this particular session is the portfolio. We have come up with a couple of stocks in last few days after there was an announcement of a possible successful vaccine coming from Pfizer and Bion Technology and a couple of more pharmaceuticals. Few companies or stocks which can get benefited from it. So we have made a list of that. And I see more and more people joining and voting. So please continue to do that. There will be a vote right there. In the next 5 seconds, I'm just going to finish the poll to ensure that we can go ahead with the presentation. So 5, 4, 3, 2, 1. So I'm going to end the poll now. Anybody who has not voted, please vote. And I'm going to publish the results as well. So 42% of the crowd said that they did invest during the lockdown, while 57%, a considerable majority, said that we have not invested. We had not invested in any stocks during the lockdown. So those who invested, well done, because you must have seen your returns phenomenal, unless it was energy sector, because energy stocks might have come down a bit. But then the energy stocks came down in last 2 months. But otherwise, from during the lockdown till the lockdown got over, the stocks actually went up. So those who invested in the stocks during the lockdown, you must have seen decent amount of returns. Those who had not, don't worry about it. But yeah, the idea of asking this question was to tell you the fact that with every time when the volatility comes in, it presents the opportunity also. So that's what we are kind of discussing today. And going ahead with the session, I just want to make sure if you have any questions, anyone, please keep writing over the chat. I'll try to answer this question. All the questions that you have once the session is over, I'll try to answer it, or while we're in the middle of the session, we can quickly take 1 or 2 questions and try to understand. So please keep writing if you have any doubts. Now, when we talk about financial markets, as I said, we are not, please have your notepads with you. Whatever I will say, maybe 1 or 2 points might be of your interest. So you want to note it down. I'm keeping my notepad right now, right here. Please have a notebook or a diary for yourself and make sure that you note down points which you feel it's important. When we talk about financial markets and investment asset classes, most of the investors are facing a concentration risk. What is the concentration risk? Concentration risk simply means that we are inclined towards one specific product or one specific asset class. Some of you would only invest into real estate. You find benefits, advantages, that's entirely up to you. But the reason behind this, some of you will only invest into real estate. Some of you will only invest into stocks. Some of you will only invest into bonds. Why? Because maybe you feel that this is one asset class which you have gained some expertise. You might have done this 10 or 12 times, so you realize that Okay, this is my area. This is what I know. So nothing wrong with that. But what happens is, what you think is expertise is just the favorable side of the trade. And if anytime you land on the unfavorable side of your trade or of your investment, you see a loss, and that can happen. It's the uncertainty around every investment, the volatility around every investment. It revolves, it prevails, it exists, and it is inevitable to invest anywhere which uh, which says that risk free. Nothing is risk free. Any asset class, which or any company or any fund manager investor says this is going to be a risk free investment. It is not going to be a risk free investment ever. Everything has risk. So it's just about high risk and low risk areas. When you invest into bonds, less riskier than stocks, but more riskier than fixed deposits in your banks. When you invest into commodities, more riskier than stocks. When you invest into stocks, obviously less riskier than commodities, but more riskier than bonds. So every asset class has their own risk and reward. And for in us investors, we have to identify what product is made for me and what not, or how much quantity I should invest. So please do not, whatever I'm going to tell you today is for information purpose. Even the portfolio which I'm going to discuss at the end is for your information. You want to invest into it, please talk to your risk consultants, your financial consultants, your experts, and only then invest. Do not borrow money, take a loan, or think that you are going to make 100% profit or anything. We are not here to give any kind of assurance. This portfolio or this presentation information is prepared on the basis of the current market figures, and it can always change, but then we always try to give you the best view and understanding. Right now, what happened in last month, or not say last month, what happened in the beginning of this month, something which was very crucial, something which was very important. Please write on your chat. Let's try to make it more interactive through the chat. What was one of the most important significant event which happened in the first week of November? Go ahead, guys. I'm getting answers. It's good. Please keep writing. It will keep you engaged, involved, and it will definitely prevent you from leaving this session. So keep writing over the chat. What was the main event? What was the iconic event which happened in the first week of November? Okay, got one answer, two answers, one more, three, four, five, six, eight. Okay, okay, great. So everybody on board with it, right? U.S. elections happened. U.S. presidential elections happened, and the biggest turnaround in the history of elections which we saw was Donald Trump lost. Which, if so, we were there in the evening tracking the elections, and in the morning, Dubai time around 9:30, I left office to get freshen up and come back. And by the time I left, it was a complete sweep. At least that's what it appeared to be. That Donald Trump is going to win the U.S. elections, and not only that, but the Congress, Senate, and the House will also be Republican. So, just to give you a small understanding of uh, this is the result. Obviously, Joe Biden won, and we can see all the states which got flipped. Arizona got flipped for Donald Trump, which was highly unexpected, and so did Michigan. Uh, Georgia started turning blue, which was a big setback again for Donald Trump. So now let's try to understand a bit what actually happened in elections and how does it work. Every president in the White House, which you see in the middle, has to work with the Congress. Congress, as you see the first column, this is the legislative which make laws. And the Congress has two parts. One is the House and one is the Senate. So the House of Representatives have 435 members, and every 2 years they go up for the election. Senate, on the other side, is also concerned with making laws. So if, say, Joe Biden or Donald Trump has a plan, that plan will not be executed without the approval of the Congress. And Congress can be Republican, which means red, or it can be Democrats, which can be blue. So even if you have a president which is Democrat right now, that is Joe Biden, but if you have a red Congress, then it will still make it will be a problem for the president, because a Democrat president will find a difficulty in carrying out laws if there is a Republican Congress. And that's what has happened. So what you see right now, the Congress is pretty much split. The Senate, the first 100 senators which you see, Republicans have got a majority, while the House still belongs to the Democrats. So it's a split Congress. While the White House, the building which is the executive, White House president is Joe Biden, and he's a Democrat. So we have a blue president, a Democrat, and we have a mixed Congress, which means we have a Republican Senate and a Democrat House. So this again is going to bring a lot of motion, a lot of volatility and fluctuations in the market, because not every law which Joe Biden will make will be passed easily, because there is a Republican Senate, and that's a mixed government which we see right now. So these are the branches of US government. At the end, you can see the judicial system, the Supreme Court, which as of now is dominated by Republicans, and there are 9 chief justices, and one of them got appointed this year, and which was a Republican. So this is how the US government functions. Now, why I'm telling you this, you will have a question, what do I have to do with how many branches US government is divided into? That is because the impact on stocks, commodities, currencies, it will have a major impact depending on whether the president is a Democrat or a Republican, whether the Congress is with White House or is against White House, or is a split. So basically, if what we have right now, so let me give you some statistics and numbers in the past, because that is going to help you out in understanding that how US elections can impact the financial market. Because only when you know what has happened historically, then only you will get to know why this is of major significance. Please keep asking questions if you have any, and I'll try to answer it, as I said. Now, let me show you some statistics. The ideologies of Democrats and Republicans are very simple, but I'm going to tell you strictly towards the stock markets. Mostly and historically, Republicans, which means Donald Trump, belong to the Republican Party. Republicans have been taken as pro stock market, pro entrepreneurs. They would like to reduce down corporate taxes so that the companies can grow their earnings and expand more and generate more employment. So that is one big factor. They do not. They like to keep interest rates low. They like to have more and more stimulus. Now, this is one thing which we have learned from Republican government, that they are pro stock market. At least this is what has been the ideology. While Democrats, they believe in a system where the rich people who make more money should pay higher tax. The ones who do not make more money should pay lower tax. So that's why when it comes to the big corporates and the companies, Democrats have always been known for increasing corporate taxes, which can reduce down the earnings of the company and reduce down their profitability, bringing the stock price down. So that's the end result of what happened. So that's why when Donald Trump became the president in 2016, we have seen one of the best bull markets from 2016 to 2020, and we will plot this in the chart also, and we'll see this in the chart, that how from 2016 to 2020 S&P rallied before the pandemic hit. That is primarily because Donald Trump has been reducing corporate taxes. That has boosted up the earnings of the corporates. The companies' stocks have gone up, revenues have gone higher. But this is where things change. If you see from the very beginning of when Franklin D. Roosevelt became the president, who was a Democrat, till Donald Trump, on an average, stock markets have given higher returns during a Democrat president and lower returns, around 6.2% during the Republican president, while around 9% returns during a Democrat president. Now, this has been a historical performance. So you'll be surprised to know that why it is. If Republicans increase the corporate taxes, that is good for the earnings of companies. Then why stock markets have performed better during the Democrats? That is because Democrats, they like to have higher government spending. They like to have more stimulus, more financial aid by the central bank, by the government, so that they can spend more money on infrastructure, on construction, on other kinds of spending, so that the cash eventually reaches to the people and their purchasing power increases. So basically, there are different ways where Democrats are more heavy on government spending and stimulus. We have seen Republicans are more heavy on reducing down the corporate taxes. So we eventually saw that the stock market returns have been higher when a Democratic president comes in. And right now, a Democratic president has come, right? So this is something which is important for you to understand, that historically, stock markets have performed well under a Democratic president, which right now is Joe Biden. Second thing, many of you have always asked, I have met a lot of people, I've done a lot of trainings, webinars. We used to do a lot of seminars before um, the pandemic hit. And every investor had this question. So, what do I do if I buy today? If I keep it for longer term, what happens eventually? Or how much the elections impact my investments? Now, we are doing this session today to understand that what are the investment opportunities post US elections, because elections have happened. Biden is a clear winner. I don't think this is actually going to court because the margin is so big. The winning margin is so big between Biden and Trump. So I don't think Donald Trump is going to take this to the court. So we take Joe Biden as the president now. And how it impacts your investment. So another data historically, if you see from 1933, had you invested $10,000 in 1933, you would see that growing, and this is S&P 500 return, to $136 million by now. That is 2019. I consider inflation adjusted figure also. But imagine, I mean, if had you put $10,000 in 1933, that would be $136 million now. It's a big thing. So even an inflation adjusted figure is very impressive. What you understand is, if you keep yourself invested in the stocks over a longer period of time, we have seen stock markets going higher since 1933. And this is a very important thing because a lot of investors feel, so I just took a poll and 57% of you have not invested in stocks during the pandemic. And pandemic was one of the best times to enter into the market. It's not like right now there are no opportunities. Opportunities will always be there. But then you have to understand that even with the pandemic at course, we saw a lot of people entering, institutions entering, and growing their portfolio further. We'll look at the live charts as well. So this is something which you can understand that irrespective of a Democrat or Republican, over a longer period of time with minor hiccups, the stocks have continued to go higher. So this is one thing which you have to feel, that stay invested. Do not get scared that elections are there or pandemic is there. You have to stay invested in the market for a good period of time. Now, one more thing which you have to see, stock markets, when we talk about the importance of being invested, why I say that, right now you are looking at the graph in the chart of S&P 500 from 1990 to 2019, $10,000 investment. And what we are trying to understand here is S&P 500 has some days which are very good, which we call as best days of investment. And if you were fully invested in these 30 years and you have taken all the best days into account, where S&P has gone up by 4% or 5%, your money would have grown from $10,000 to 172. But if you have missed out on 50% of those best days, then, if you have missed out on 10 best days out of the 30 best days in these 30 years, your investment return has come down by 50%. Similarly, if you have missed 20 best days, your investment return has come down by almost 70%. And if you have missed 30 best days of S&P 500, then your investment has come down by 80%. Now, this is an important thing. Please note this down. The best days of S&P are the one which came off lately when we saw S&P moving around 4%, 5%. After the news came out that Pfizer and biotechnology have stated that their vaccines could be 90% effective. And that's when the S&P rallied. So this is the best day. And if you're not invested, that could be one of those best days which you missed. So it does matter when you keep yourself invested in stock indices, because if you miss out these few best days, your return can severely get affected, right? So another historical data. Also, this is something which is very interesting. This is the S&P 500's total ending value 10 years after the start of a presidential election year. That means if you see, let's say from 2008, when Obama became the president, till 2018. So when Trump became president from 2016 till 2026 will be the next 10 years. What you have to see is how the hypothetical investment of $10,000 grew at the beginning of the election year till the 10 years. You will see, except 2000 to 2009, all the years have shown positive returns. So if you had invested $10,000 in 2016 when Donald Trump became the president, most probably by the end of 2026, the returns could be positive given what we have seen in last few election years. And I'm talking about from 1936. So it's a pretty big number what you see right now. Percentages may vary, but at the end of the day, what I'm trying to show you is a positive decade after an election happens and after a president comes in. So something which also you can note it down or click a picture. Now, this is the current status of where we are right now. We are looking at a Democratic presidency, but a Republican Senate, which means Joe Biden is a Democratic president. The House of Representatives, which is one part of Congress, is blue, which is Democrat, but the other part of the Congress, which is the Senate, has become Republican, which means that will be controlled by the Republican Party of Donald Trump. Now, under this, what is going to be the scenario? How the important policies are going to shape up? How these kind of policies related to corporate taxes, policies related to personal taxes, policies related to minimum wage, fiscal policies, how it is going to shape up? So if you talk about corporate taxes, if this was a complete Democrat, a Democrat Senate, a Democrat House, a Democrat president, corporate taxes would have definitely gone up, because that's what Joe Biden stated, that first thing he's going to do is increase the corporate taxes. And that would have been bad for markets, bad for stock markets, because increasing corporate taxes is going to reduce the profitability of the company, which will be displayed in the earnings every quarter. So that was one big worry. But now with the Republican Senate, it will not be very easy for Joe Biden to do any tax hikes among the corporates. So corporate tax hike could be scaled back. If we talk about personal taxes, there were some tax cuts also, and with the Republican Senate, it will not be easy for Joe Biden to reverse those tax cuts. So we are not expecting any one of those. Now, looking at the minimum wage, so Democrats have also believed in increasing the minimum wage of the people, and that could be again a hit to the labor-intensive companies like McDonald's or Uber, and that can reduce down their profitability. But again, with the Republican Senate now, minimum wage could rise, but by a very lesser percentage. Earlier, it was expected to be going up with a higher percentage, and that would have again impacted the corporate profitability. Fiscal policy, which means there was a pandemic stimulus which was pending, and stimulus means a financial aid, increasing the supply of cash in the economy to prevent an economic collapse. So that fund, about $2 trillion, was expected, which is now going to be less of not 2 trillion, but could be around $500 billion. So markets will get a financial aid, will get a boost up, not $2 trillion, but could be around 5 billion. So this is how the corporate tax status, personal tax status, wages, and fiscal policy are worked out. Talking about healthcare, Democrats have always stood for lower drug prices. So this is something which could be expected. And most important, the regulation. One sector which has outperformed in 2020. If anybody knows which sector has outperformed in 2020, utilities, energy, financials, please write down on the chat. Don't worry about the right and the wrong answers. Let's make it more interactive. Which sector do you think has outperformed among all the sectors like financials, technology, energy, consumer staples, consumer discretionary? The best performing sector, even during the lockdown. Go ahead, guys. Answer. Whatever you feel. Could for you it could be healthcare, could be pharmaceuticals, could be airlines, anything, whichever you feel. Okay. Everybody's it's amazing to see everybody's on the same page. This is a very informative, brilliant crowd. Everybody's aware of what's happening. Okay. So, somebody said pharmaceutical, they did perform well. Healthcare performed well, definitely. Technology actually outperformed a lot of sectors. So, technology is the first answer, but definitely healthcare, pharmaceuticals also. Food and beverage. So, food and beverage, I would rather say specifically packaged food industries gained a lot of momentum during the lockdown and the pandemic time. So yeah, I mean, in a way. Otherwise, food, if we talk about restaurants, did not perform very well. In fact, it went completely opposite because during the lockdown, a lot of restaurants, people kind of resisted from ordering outside. So restaurants took a big hit. Even in UAE, if you see, a lot of restaurants got shut. So food and beverage among restaurants may not, but yes, normal grocery, or packaged food industries did really well. So what we have understood is there were a lot of sectors. Technology outperformed everything. First thing, Zoom technology. Everybody knows Zoom now. We are going to have more and more social distancing. Pandemic, even after the pandemic is over, I'm sure everybody's going to take care. Now everybody knows how Zoom works. Virtual meeting is a reality now. So people don't mind meeting virtually. People don't mind being conducted with a Zoom call or sharing proposals and sharing ideas on Zoom. It has become a lot more easier now. So technology is here to stay. Technology has outperformed. But during Republicans' time, during Donald Trump's time, there was not really too much regulation of how technology is working because Donald Trump always wanted stock markets to go higher. And for that, tech stocks have actually contributed a lot. Tell me, when I say the word FANG, FANG, What does FANG stands for? FANG. Hope if you can see this. Okay, this is inverted. FANG. What does FANG stands for? FANG. Whatever you feel. I will give you a hint. FANG is related to technology. So, and it's an acronym. FANG. What do you think it stands for? So I'm writing it in my notebook. You can write it over the chat, and definitely our answers will match. It's a very informed crowd. Okay. Getting answers already. Okay. Okay. Okay, so Facebook, F stands for Facebook. A lot of people said Facebook, that's good. A could stand for Apple and Amazon and Alphabet. So G stands for Google. A stands for Alphabet, Apple or Amazon. It once it stood for Alibaba also. So yeah, not Microsoft. N stands for Netflix. Yes, definitely. So good answer, everyone. Well done. FANG is an acronym which stands for Facebook, Amazon, Apple, Netflix, Google. A lot of stock market returns which got generated this year were majorly stimulated by higher returns in these FANG companies. So tech has actually outperformed, and it has contributed a lot in the total return of S&P 500. So it's a big thing. That means tech is becoming a very important part of stock markets. And that's why Donald Trump has made sure that the regulation in these companies, in these technology related companies, not too much, because they're performing well and they're pushing the stock markets higher. Now, with Joe Biden coming in, that regulation, if there was a Democratic Senate and a Democratic House, that regulation would have been higher. But with the Republican Senate, that regulation could be less, but it might still be there. So yeah, tech stocks can perform accordingly. And then foreign policy, not to mention US and China had gone through a very long trade war with a lot of issues. There have been trade deals, different phases, and eventually we saw tariffs being put from US, from China, and there was a lot of stock market movement around that. Now, with Biden coming in, with the Republican Senate, we feel that the stance with China is still going to be tough. The US is still going to be strict with China, but then it will be more diplomatic. So that means slightly good chances of a controlled and a diplomatic approach, something which Donald Trump has not done in the past. So that is one thing about foreign policies. Biden has also talked about removing sanctions of Iran so that Iran can again start contributing into the OPEC community with their oil. So that could affect energy prices as well, because the supply glut might come in. So those are a few things which are the part of foreign policy, not to mention the Paris Climate Agreement, which is the environment policy. Now, what was the market impact? Now, when I was making this, what we expected was a very marginal impact in the stocks. So of lately, the stocks which have gone up now is because of the fact that there has been a positive news about the vaccine. Now, that has actually pushed stock markets higher, at least by 4 to 5% than where it was. So that's good. So it has actually generated a higher impact. What we expected was a very marginal impact. Dollar expecting a gradual decline of USD, given the fact that there is a possibility that corporate earnings might get impacted. So a small decline in dollar, which is gradual, it is expected. In stocks, slightly positive or negative, but lesser impact or neutral. But now the things have changed. When I made this presentation, that was just right after the elections happened. And last 3 days, what we have seen is there is a current movement because of the positive vaccine news. So we have seen a positive stock market movement. Gold, exactly. If there was a complete blue wave, a Democratic House, a Democratic Senate, and a Democratic President, we could have seen positive price movement in gold, and that could have been really impactful because more stimulus means dollar getting weaker, excess supply of USD, and then dollar getting devalued while gold moves higher and higher. So that was something which was expected, but now it's not a blue wave. So we have seen gold prices also getting corrected against stock markets going higher and higher. Now, after this, few election sensitive sectors, which we have already seen moving higher. So if you see, technology stocks have and technology stocks which are related to work from home have come down of lately because of the positive news of the vaccine. But other companies which are related to renewables, so Democrats have been believers of green energy, and mostly about when we talk about a green energy, clean energy, less use of fossils. This is what Democrats have stood for. While Republicans like Donald Trump have always believed that climate change is a hoax created by China. So not much environment regulation we expected during that time. But now a lot of renewable companies which are related to solar panel manufacturing, semiconductors, lithium mining companies, battery related car companies, they might be again in demand, while industrials, something which is related to the development of infrastructure, construction, materials, that might also get a lot of momentum given Democrats are heavy spenders. Government spending might increase during this time. So industrial stocks can also gain a lot of momentum. So these are the winning sectors, while the losing sectors, we talk about oil and gas, healthcare, technology, and communication. Now, in spite of elections, there are few trends which might continue to grow, and that's why we have brought these things, these sectors in your light, so you can understand that which are these. Just give me 1 second, guys. So there are few sectors which we have seen during these trends that this will continue to show a good growth. And we are talking about sectors which are related to wind capacity, digital mobile payment. That's one of the most important part of the technology, the digital mobile payment. So companies like PayPal, Square Payment, MasterCard, Visa. Then we're talking about companies which are related to DNA sequencing or increasing the internet capacity, or internet companies which are related with internet traffic. Digital health data. This is a very important. Now, if you see, you have Fitbits and so many other devices monitoring your health, monitoring your steps, monitoring your percentages. So this is something which you can also look into. So somebody just asked me a question: why is healthcare projected to be a losing sector? So see, now it depends a lot, obviously, how the government takes the initiatives. Normally, the first bit, what we see, and don't relate it to the pandemic, because with the vaccine news coming in, a lot of companies like Pfizer, they have already moved higher and have reached to a territory where we can say that they are overvalued and not undervalued. So healthcare, we have not put in a losing sector. We did, although a cliche or a stereotype reply for this is Democrats, they always believe in lowering down the drug prices. Their healthcare policies are where government is the center point of creating healthcare. So the Affordable Care Act, or the Obamacare, which is in motion right now, which is running right now, it involves government distribute, like the healthcare should be distributed by the government, while Republicans believe in involving private sectors into distribution of healthcare insurance, which means what Republicans say that every individual in America should have the right to choose their own insurance provider. So that is something which could boost the private sector of the health. But with Democrats coming in, they always talk about lowering the drug prices, which can reduce the profitability of the healthcare company. So that's why we normally put it on a losing side. But then again, as I said, this is something which is based on the information. Once they start selling the actual medicines, they will not make money in millions. So another contribution to this by someone, that once they start selling the actual medicines, will they not make money in millions to all over the world? So when it comes to, so guys, let's take a bigger picture also. Vaccines and the trials, this is something which has been long talked about. And there are a lot of companies which will get benefited. So this was first thing one investor asked me after Pfizer came with the positive news that 90% of their vaccines, like vaccines are effective 90%, the ones which are created by Pfizer. So should I buy Pfizer? And if you see Pfizer closely and if you read their balance sheets, you will realize that valuation wise, the current stock price, which when it went to 42 or 43, that was the almost the fair value of Pfizer. It could not go any higher, even if they started selling those drugs and generate revenue from it. So many a times, news coming in might stimulate us to enter and take a position just on the news of okay, the vaccine is coming. But if you see stocks like Moderna, stocks like Pfizer, stocks like AstraZeneca and others, there have been a lot of rallies in these stocks, even in the beginning of the pandemic, because there were expectations. So it is not necessary that once they start selling this, their stock price will actually go up and the earnings will be justified, because markets have priced a lot of action over here. There have been a lot of news and stocks have gone up by 200%, 300%. So you never know whether this will have the same impact or not. So that's why numbers are more important. We should always follow the numbers and see that the current stock price of this particular company, whether it is fairly valued, overvalued, or undervalued, and try to eliminate the noise factor from that. So that's really important. Another sector which we are looking at is EV, last sector, electric vehicles. Companies like Tesla, companies like General Motors, which are companies like General Motors, which are in the line of electric vehicles or battery vehicles, they will also get benefited. So look at this way: electric vehicles. This is one sector. So the company which are making electric vehicles like Tesla, companies like General Motors. I'm sure Volvo is also into this. And then think about those companies which are working on the source of these batteries. So electric vehicles run on batteries, and these batteries come from lithium. So imagine all the lithium mining companies, how much they will get benefited. So when you're looking at electric vehicles, just don't look at companies like Tesla. That's just one thing. Look at this very source of the battery. It's lithium. So look at the lithium mining companies also. Look at those funds which have lithium mining companies into it. So this is also something which can work out over the long run. Now, this is just for some basic information, because this is sometimes we get confused over this, that which are good sectors to invest into during economic phases. Our economy has 4 phases. There is acceleration, which means growth at a higher pace. And then comes a moderation, where we see where the saturation point comes in when it has already grown. And then there's a slight diminishing point where the growth is there, but it is at a diminishing rate, and then it saturates, and then it starts coming down. The speed gets slow, and then eventually the economy gets into recession, and then there is recovery and acceleration, and again. So which are the sectors which we should all look around these areas? So when there is acceleration, in economic growth, we should look at sectors like consumer discretionary, financials, industrials, IT, materials, real estate, because the economy is growing. So industrials is good, IT sector is going, it's good. Consumer discretionary, the ones which are more branded items, people would go, they have enough money to buy it because the economy is growing. And if you see, compare it with the last recession, you will see that the important consumer staples, companies like Walmart and etc., healthcare, utilities like General Electric, these are much more important during the times when there are recession. That's where these sectors will outperform. But companies like IT and industrials will not outperform; they will underperform. So, to give you a proper understanding of this, there are different kinds of strategies. So, this is something which you can take a picture of this or write it down. Just after this, we'll discuss the portfolio also. Let's say we are trying to put a defensive strategy in order. If your goal is to reduce volatility and risk in your portfolio, you should go with a defensive portfolio. That's your first strategy, which is a defensive strategy. You are looking at the economy. If the economic slowdown is there and you don't want to take too much risk, you don't want to take too much, you don't want to see too much fluctuations going on in your portfolio. So what you can do is you can go with a defensive strategy. Now, to do that, you have to invest in a sector which normally outperforms when the economy is slowing and is less volatile. So those sectors are healthcare, consumer staples, and utilities. Consumer staples, these are your needs, which you definitely want. Stocks like Walmart, Target, these might be good areas to invest into. Utilities like General Electric could be a good idea to invest into. Somebody asked, can we get a copy of these slides? I would suggest if you can quickly take a picture, it will be really nice. Otherwise, it will get uploaded on YouTube, so you will have a recording of that. So don't worry about it. Then opportunistic strategy. So if you're anticipating that now the economy has started growing and your goal is to magnify your returns, to enhance your returns, increase it, then you will start investing into higher volatile stocks. When I say higher volatile, I mean lot of fluctuations, lot of price movements, and IT sector is one of those sector which shows a lot of fluctuation. If you see last 1 year of Apple or Tesla or Netflix, Google, you will see how it has moved, wild movement. Consumer discretionary, the branded companies, Ulta Beauty or L'Oreal or other brands, this is something, again, these are luxury brands, very volatile. If you want to be opportunistic, you are looking at a growing economy, you want to increase your returns, you start investing into a high volatile sector. Definitely, again, guys, please understand your risk and then invest. Do not just enter because you think it's opportunistic part, because it can have an adverse impact also. Third is a preemptive strategy. So when you're expecting that, okay, now inflation has gone up, you want to protect your buying power because you are expecting that inflation will start growing more and more. Now, to do that, you have to invest into companies which are related to real estate, which are related to materials. So when inflation starts picking up, people have more money. That's why inflation has started picking up, because they're demanding more. So when they're demanding more, they are expecting. So when they're demanding more, that means there will be more construction, higher infrastructure, more houses. So real estate and materials are the way to do that. You can invest into it. You can invest into energy because everything is getting expensive. So fuel prices, oil prices also start getting expensive. So these are the sectors which you can invest into if you want to protect yourself against inflation. And that's where we reach to the end of this, where we discuss about the feast portfolio. Now, the feast portfolio, it stands for financial, entertainment, airline, shipping, and travel. Now, why we are talking about this is prepared by one of our expert research guys, Sharon, and this is something what I wanted to talk about. Last 1 week, we saw, apart from the elections, what also has happened. So let me quickly first show you which stocks you can invest under a Biden presidency. You're looking at a Democratic blue wave, but that didn't happen. But we still have a Democratic president, so we might see a movement in renewable energy, infrastructure stocks, and healthcare. And these are some stocks which you can right now look at it. But please, as I said, do not just go and buy it right away. Please understand your risk. Understand the idea of how much you should invest, what is the risk versus reward, for how long you can invest into, what are the price targets, and etc. So infrastructure stocks, you can see green energy stocks like Tesla, then solar energy stocks like First Solar, hydrogen energy, Plug Power, electric utilities like NextEra, healthcare, another managed healthcare we are talking about. So again, guys, see, if you see healthcare, Biden will likely ensure Medicare for all, which would imply strong benefits for healthcare sector firms. If Biden upholds Obama's 10 years Affordable Care Act, this could likely act as a strong trigger. So as I said, healthcare normally we put into the losing sector because Democrats, they want to lower the drug prices. But then depends a lot on how the government plays the healthcare part. So over here, there are few companies which can get benefited from this. Then there are some construction companies like Vulcan Materials, Martin Marietta Materials. So this is something which you can look into under Biden government, mixed of the sectors which can get benefited. Coming back, what we were discussing about is the fees portfolio. So now there are few companies with, when the Pfizer's news came up, it fired up the market. Global economy is likely to get a leg up in 2021 with the announcement of its trial results. And that was something which was unusual. We were not expecting a news that early, and that too after the elections, but we had it. So now what we see here is, based on the outcome of phase 3 trials, efficacy of Pfizer's vaccine is now estimated at 90%. That's good, better than expectation of 70%. They are planning to produce 1.3 billion doses of vaccine, and along with other successful vaccines, this should help a substantial part of global population. Now, what we have done is, instead of targeting more and more pharma stocks, because everybody keeps talking about pharma stocks, rather than targeting that, we are trying to find some value in those sectors which were battered down during the lockdown and the pandemic. And with the vaccine coming in, those sectors might again open up. So that's where you will see companies which are related to financials, entertainment, airlines, shipping, and travel. These sectors were battered down completely. And now with this vaccine coming in, those sectors might get a boost. So these are some names which we have picked up. Guys, again, as I'm saying, please, this is something which is on the basis of current information. Please understand your risk and understand that how you will take the exposure in all these companies. Somebody just shared an information with me. Pfizer has announced it's a 95% effective today. Absolutely. Just in front of me, there is a Bloomberg session which is going on right now. So they announced it is 95% effective. So definitely, I mean, it's a positive news. But given, as I said, the valuations are very important. Even after the vaccine comes in, what will be the valuations of the company? Is it already priced in the news, or this is something which is going to put the stock price further higher? So what we are doing is, rather than being too much exposed to the medical and healthcare, we are going further to those sectors which were being battered down. So you see stocks like Citigroup and JP Morgan, which have a good dividend yield, by the way. Good dividend yield of 3%, 4%. It's a positive time. It's a good yield. Market capitalization of around $1 billion, $100 billion, $346 billion. Then we have Walt Disney, Six Flags, IMAX, and see the yearly highs and yearly low. And look at the current market price. Like Citigroup is still at a 50% discount than their 52-week high. So that is a big thing. If you see companies like IMAX Corp, that's a theater-based company. So current price $14, 52-week high was 22, 52-week low was 6, and this is related to entertainment. Another few companies, this is related to gambling, casinos, Wynn Resorts, airlines like Southwest and JetBlue, shipping companies like Golden Ocean, and travel, Lyft. A small idea of how the Bloomberg has they have rated these stocks. Out of 27 analysts in Citigroup, out of 27 analysts in Bloomberg, 21 suggested a buy for Citigroup. 6 of them suggested a hold, a strategy not to do anything. For JP Morgan, 20 buy. For Walt Disney, again, 21 buy. Six Flags, 50-50. Some said buy, some said hold. But most of it, if you see, we have gone for. So JetBlue, if you see, six of them have suggested a buy, one suggested a sell, but 10 of them suggested a hold. Now, what are the reasons behind this? Before we conclude, let's have a small discussion and understand. You can take pictures of this. And again, guys, will be always available for a one-on-one session. So we can always do that. Now, Citigroup, why we are looking at, so Pfizer and BioNTech vaccine announcement has buoyed banking stocks. And reason for the bullishness on banks are pretty clear. While banks entered the economic crisis spurred by the pandemic in a strong position, investors were never able to shake their fears of coming loan losses. So positive vaccine data has given investors reason to hope that the economy may soon be able to fully reopen, providing a much needed lift for hard hit sectors such as travel and entertainment, which either needed to fully shutter or operate at reduced capacity over the last few months. So the businesses come back, investors will have less fear, and banks' loan books will again start hitting. So we are looking at a lot of financial sectors right now because people might again start taking loans if the economy again goes up. So the revenue of Citibank has been around $17.3 billion. This is ahead of the estimates, which is good. Earning per share is good, better than analyst expectations. So that was a good thing. A lot of revenue came from the trading desk of Citigroup. So that means a lot of people have invested and traded. One question, are we looking at a dip in stocks as cases go up and before Biden takes over? So the fear of second wave did brought stocks down. So we'll look at this chart currently and we'll see. It did brought down just before the election around September. The fear of second wave coming in and lockdown in Italy and other places have actually brought stocks down. But now with this news of vaccine, okay, while we are doing this, let me quickly show you, while most of you are here, how markets have reacted to the news of the vaccine. This is S&P 500, so I'm going to take the global benchmark right here. Let's go last 1 week. So this is what I wanted to show you right here. Look at this. This is on 9th November when the news came out. So from 3558, which is S&P's price, that day, 3,558, it went up to 3,656, almost $100 up in 15 minutes. This is a candle of 15 minutes. In 15 minutes, markets went up. It did come down right again here. And then again, when today the news came up, we have seen again, it moved right here and now it is trading at the higher levels. That's 5% higher than where it was before the election. So markets have moved higher. And in September, if you see, let me show you last 1 month, October and September. That's where we have seen that the stock prices coming down here, October. And then we saw in September, look at this big fall which happened in September. 3,600 went down all the way to 32. That's a big dip, right? More than 10%. And that's where, again, it started going up when the election started moving higher. Again, came down when the lockdown started. So European, a lot of bad news from Europe has come down and stocks have gone down. But now with this news again, we see this spike which happened. And that has kind of given the momentum to the markets going higher. So a lot of rally which we have seen currently is because of this reason. Gold prices have dropped and they have still continued to be getting a strong support around 1861. So that's really important, a good buying level for 1861. Okay, so quickly coming back to the stocks we were discussing, Citigroup is one, moved on to JP Morgan Chase, best performing big banks. Even during the Great Recession, we have seen JP Morgan going higher. They have beat their earnings estimates. They have outperformed the revenue also. Almost the same revenue which they declared the last quarter, so that's good. Net income has doubled more. It's around 101%. And that is, again, they have already put a big provision, a reserve for credit losses. So that's a good thing. Now, what we have seen is JP Morgan's balance sheet should serve it well thoroughly in any scenario, just as it did through the Great Recession. So that's really important. Now, this is one of the best capital position among the major US banks. It has increased its liquidity sources to 1 trillion. Best efficiency ratio for four major banks at 58%. So JP Morgan is also something which is expected to do better, followed by Walt Disney. Now I'm slowly diving into the sector which is less talked about, because entertainment sector was not very well taken during the pandemic. Now, why we are looking at, again, viable vaccine hitting the market in coming months, Walt Disney, a shot in the arm. Companies in the midst of a transformation from television and movie theater driven distribution to direct to consumer business. Disney Plus is already in. They will have three distinct content production groups: studios, which is Walt Disney Studios, then there is Pixar, there is Marvel, there is Lucasfilms, and then they are making movies and series for theaters, live streaming, the general entertainment, which is Disney channels, National Geographic, and others. And obviously the third one, which is sports, responsible for content for broadcast on ABC and ESPN. So this is ESPN Plus, which is streaming for ESPN. So they have, again, they're diversifying into multiple areas of the entertainment. There is their focus on streaming entertainment. That's good, because during the pandemic, we saw a lot of people went on to live streaming again because nobody would go to the movie theaters. So obviously, when we talk about rivals like Netflix, their subscriber growth is slowing down while Disney Plus is picking up. So that's a good thing. And they're going to spend more and more on the programming for the entire year. So that's a good thing. And that's why if the vaccine brings back normal life, that will be a big boost for its theme park and movie business. So that's something which we are looking at. Followed by Six Flags Entertainment. And this is also one thing. So Six Flags has suffered significantly due to the pandemic. Positive side, cost reduction management are projected to improve baseline earnings. A lot of transformation is happening. So when we are looking, again, Six Flags is an entertainment company, guys, for those who don't know. And world's largest regional theme park operator and North America's largest water park operator based on the number of parks. So this is, again, a very specific area where we are targeting, given if the vaccine comes in. So I'm not only giving you healthcare and pharma and medicines in this, not just one sector. I'm giving you financials, I'm giving you entertainment, I'm giving you airlines or travel. Again, IMAX is one of the industries which got really battered during the pandemic. But again, we have seen a strong rebound in many markets around the globe, with Asia in particular exceeding the expectations. Recovered more quickly than any industry. China, 20,000 theaters, many new impressive complexes are opened with big budgets. So that's a good thing. If North America also recovers, IMAX can really further go up. So that's a good thing about the stocks. Again, you can read more about this. You can have a one-on-one conversation with me if you need to know more about these companies. I'll take one definitely. So Wynn Resorts is a casino. One of the reasons Wynn shares lag its peers is because it's more heavily reliant on just its properties in Las Vegas and Macau. An effective COVID-19 vaccine more positively will affect the physical casino locations. Investors see it as a better value pick at this point if a vaccine helps the casinos get back to pre-pandemic levels. So that's a good thing. Company is well capitalized, good amount of cash on the balance sheet. Capital expenditures are down, and they are expected to generate a good amount of earnings before interest and taxes. So that's a good thing, good valuation about a company, right? I'll just take one more airline stock. Southwest, we have talked a lot about Southwest, and it has, pre-pandemic, it has given a good return, and then pandemic, it came down. But then again, I'm just reading a news right now, guys. I'm not distracted. I'm just reading a news that FDA panel may meet early December on COVID-19 vaccine. That's just, I'm reading right now on CNBC, and may discuss both Pfizer and Moderna vaccines. So while we talk, again, there's a news coming in. So Southwest Airlines have been among the hardest sectors which is hardest hit, and that was airlines. But since Southwest was a domestic airlines and they had a very good balance sheet, so we have seen Southwest Airlines recovering really quick. So, guys, again, when you're picking out stocks, even in any sector, you have to pick out the stock which is less volatile, stronger. Even in restaurants, you have to make sure that the stock which you pick is a stronger one, because anything can happen and we have to protect ourselves from these kind of risks. Then there is JetBlue Airways, there is Golden Ocean, which is a shipping company, and that is also expected to perform well if the market picks up during the third quarter. That it has secured some profitable charters, and the cash flows are at good level, and it is expected to do better in the second half. So again, guys, if you see, the iron import rose almost 19% in the second quarter compared to the same quarter. This is something which can really, if the exports start increasing, the shipping companies also, the volumes which they carry from one place to another, that can actually bring more and more success to the shipping companies. So do look at these companies. Again, as I said, this is something which is, Lyft is a competitor of Uber, but in America, Lyft is always preferred more than Uber due to its excellent service and excellent software. So this is something which you can also look into. And again, these companies which I'm sharing it with you, please do a thorough research of your own, or talk to a risk analyst, talk to a financial consultant or our experts over here. Please, before you invest anywhere, understand that all these investments are subjected to market risk and markets are volatile. So you have to keep changing your ideas of investment. Do not only invest into stocks. Meet us, will tell you what other strategies you can look into. Investments into commodities or investments into share baskets. There are a lot of things which you can see. Now, very quickly, for those people who did not invest during the pandemic, this is the reason that why I normally feel that every opportunity, every volatility has the opportunity. This is last 6 months. And as you can see, this is a big fall right here, which happened right here. And after that, the next 6 months have gone completely high. S&P has reached to a newer high than it was pre-lockdown. So markets are all-time high at this point of time. And select, US and cash. So if you see all the major benchmarks, especially S&P 500, in last 6 months, this is the important figure which I want to see. US 30 has gone up by 25%, the blue chips. NASDAQ, which is tech-heavy induced sector, has gone up by 30%. Small cap has shown return by 40%. Now that's important, that's good. Small cap comprises of the regional companies, the domestic companies, right? So that is something which is a good idea, because small cap, the smaller companies have moved higher in the last 6 months because after lockdown, the stocks picked up. So those companies which came down during the lockdown picked up almost by 40%, the ones which were small market value companies. And then look at S&P 500, the global benchmark, up by 25%. So in last 6 months, if you had invested only in the regional companies of America, the smaller market value companies, they have picked up by 40%. That's 40% growth. So every volatility, guys, comes with opportunity. And if you see all major indices, not just America, not just US, look at all these indices and look at last 6 months. Don't look at 1 year. Look at last 6 months. That's where the lockdown and the post-lockdown. Australia, Canada, Germany, Europe, Italy, everything is up by, on an average, at least 20%. So that is something which is going to be there. This is something which you can always look into. A lot of stocks have gone higher, and let's try to invest more wisely, be more informative. And that was the idea of this session. That's what we wanted to tell you by doing this session, to ensure proper risk management. And wherever you invest, diversify. Don't just put all the money to healthcare or pharmas. Anything can happen. So guys, if you like this session, please review us on Google. If you need a one-on-one session, please let me know. Talk to your relationship managers, and we'll have a one-on-one session free of cost. We'll talk about how to use the platform, how to do buy and sell, and which stocks we can look into. We can always talk about it. And please, again, remember, markets are always risky and the risk will prevail throughout. So you have to understand the very idea of having talking to a financial expert and to a risk analyst. So thank you once again for staying for this long. My name is Yogesh. If you have any doubts, please reach me out or email me at yogesh@century.ae and I'll be able to answer your questions. And before we go, please remember, keep yourself safe. Do wear your mask. I'm right now in my office, so I'm not wearing it, but outside I'm wearing it. And take care of yourself. Stay in good health. On behalf of Century Financial, my team, and myself, we give a big vote of thanks to anyone who's connected to, who has their family members or relatives in the healthcare and the pharmaceutical area. We are more than thankful for them going out and risking their lives for us. And I hope a great health and wealth to you and your families. So go ahead, guys. For some of you, I may not meet again. So I wish you a great year ahead. Happy New Year. Maybe 2021 is much better than 2020. So that's it from my end. If you will have any other questions, I would be able to answer it. Otherwise, you want to have one-on-one session with me, more than happy to answer it. I'm working on Fridays as well. So if anybody is free on Friday, I can meet or connect on Zoom. Thank you so much once again. Stay safe, stay invested, and you have a great night.